All right. Thank you so much, everyone, for joining this week's edition of Coffee with Chris. We are talking about consumer reluctancy. So some reports just came out, and it released that right now, consumer reluctancy is at its lowest point, or meaning its highest point. So people are most reluctant and more concerned about the housing market. And this is time that they've been most concerned since 1982. So that's really saying something. And it's counter to what all of the actual facts and figures are telling us. We have suspicions that the reason that people are feeling this way is because they just, for whatever reason, believe that there is some sort of 2008 happening all over again. We've harped over and over on this, and so we're not going to bore you with why that's not the case, but we do think that it's really important as people are more and more concerned, more reluctant, that we're getting out ahead of it and that we are helping to educate you guys so that you can educate your clients on why the consumer reluctancy is false. I mean, there's just not a lot of data backing it. So I've got some random facts and figures to share, but I want to turn it over to Chris because he's got some great visuals. Good morning, Chris. Chris
Morning.
is a mortgage banker. He's been in the industry, him and his wife, for 25 years. So they have a combined, 48 years experience, upwards of that way. You have seen every recession in the last 25 years. You were in it in 08. You were in it in the when the recession hit in the around 2013 or whichever year that was. And so you've seen the ebbs and flows. Thanks for taking the time this morning to share with us. So I'm going to turn it over to you.
Awesome. Well, excited, guys. Thanks for joining us. I really enjoy being able to, I love education. So what if I can instill and like take away the fear that's been kind of plugged into you during, what you watch from the media. So I think what happens is the media has been sounding all these alarms on potential recessions this year. And which, what it does is it puts like many that were questioning and buying if it was the right time to purchase a home. And you're hearing it over and over. I'm going to wait. I'm going to see if there's a bubble. But when people hear about recessions, what they're thinking about is that, well, maybe the houses are going to be on a sharp decline soon and there's a bubble coming similar to what happened in 09, 07, 08, 09. But many often what I find is they mistake this because they believe that the recession causes the housing bubble. Because since we're in a recession, we're going to cause this housing bubble. But it was quite the opposite in 09. The housing bubble actually led us in the US into the recession. Based on, if you're looking back at the last 8 recessions since the 1960s, home prices have significantly, they've increased, actually, believe it or not. They've increased or at least remained stable during the time of recession. I'm going to show you a couple slides that will, you'll have some visuals, not just me telling you. But one of those reasons that it occurs is because the interest rates significantly usually fall during recessionary periods, which we kind of seen right when the pandemic hit, if you remember, right? The rates were down to 2.75 to 3.75. But one last thing I'll say before I kind of share my screen with you guys is during the housing bubble, there was a lot of also risky non-verified mortgages. That was most of the loans that we were doing as an industry whole. So there was no stability with those programs or those loans. So that really hurt people in the end, which we don't have in this market. And there was also a huge supply of real estate on the market with a much lower buyer demand. And I'm going to get into those numbers and you're going to see that in a minute or two. So, today's housing market is much stronger than it ever was. There's 3 to 5 million fewer homes for sale right now compared to the housing bubble time. Right. And there's 14 million more households. So what does that tell us? That tells us this: there's a supply demand issue, right? Which means we're going to keep going and we're going to have strong sales in the future moving forward. So a strong demand, tight supply, it should continue to support these home prices and continue, maybe not rising at the 30-40% that we've seen in the last couple of years. Obviously, we can't sustain that kind of appreciation, but what we'll do is you'll get back to maybe even a normal 3 to 5% a year structure. So let me see here, guys, bear with me. I'm the least technical person I think on the planet, but
that's okay. While you're sharing that, so one other fact to go
oh,
with.
you have to enable me to participate for me to screen share.
Oh, I do.
Yeah. I hope we can get this. I apologize, guys. Give us some.
All right.
Okay.
You're the host now. You have all control.
Do you guys see what I see?
Oh, there we go.
There you guys go. Okay, cool. We're sharing it, guys. So, 2022, the rate dynamics, we're talking about the inflation, we're talking about Fed hikes, the balance sheet runoffs, and then the recession part of it. So there's a few slides I'm not going to get into because it goes a little bit too deep in the weeds in this call. We want to keep it short and precise, but I want to show you the Fed pattern, the history pattern over the last few big, let me go back. The last few big recessions that we had. We're looking here at the 70s, looking at who was in the Fed chair. Then this is the pandemic, not the pandemic. This was the 07. We had Alan Greenspan, and then we had Jerome Powell now currently. So if we look at some of these numbers, and we don't have to just look at it making common sense, right? If inflation was at 7 to 14% in the early 80s, late 70s, those were the rates, and 1.75 to 3.5 where we were there. Now we're talking, it's 1.5 to 8.5. So we're nowhere compared to some of these other statistics. If you're looking at it, if you're looking at mortgage rates in the late 80s, I wasn't writing loans in the early 80s and late 70s, but the rates were 12 to 18%. You probably hear your parents talking about that, or some of your older relatives talk about, they remember when interest rates were 18, they walked uphill in the snow to school, all that good stuff.
Can I interject something in here real quick?
Yes.
So I've been hearing a lot lately, which is truthful, but it's a half truth. So they say, it was, 12 to 18%, but you could buy a home for $50,000 versus now our percentages on like a $300,000 or $300,000 home, a $400,000 home. And yes, that's true. It's only half truth though, because our incomes have drastically increased as well since the 80s. So it's not a complete picture just to look at prices of home and interest rates. The income has kept up with to pay for that. So I just wanted to interject that.
That's a great point, because I don't think people realize that if you're paying 18% on 70,000, it's almost the same as paying 3.5% on 300,000. I mean, if you really look at the numbers, they're not that far off, believe it or not. They're pretty close. If you're looking at the peak in the 07 through 09 era, 7 to 8.5%. I remember when rates went down to 6, we were like, Facebook had just come out. I was marketing like crazy. Guys, you never see this in the, 6%, get your mortgages. So right now we're sitting between the, 2.5 and now like 5.5 mark, much different than what you've seen in these other markets. So as much as we start fear mongering and all this stuff, we got to realize, like, guys, we got to keep helping our clients or if you're a buyer watching this, that's interested in this, you're going to wait for something that's never going to come. And you might pay more money and the rates may be higher. So I think now is still the good time to buy. If you look at the Fed fund rates, I mean, right now we're talking 0 to 3%, right? With the raises, look at where they were, 11 to 20, 4.75 to 6.5. We're not even close to these numbers, guys. And I think it's important for you to see it, because now you're going to have the confidence to go out there when you're talking to people and say, you know what, I'm not an expert in this, but if I look at what this is, by some of the stuff and some of the information that I saw recently, points to the housing market not crashing in a sense. So inflation response, actually, it should be dropping because we're ahead of it this time. We really got really good ahead of it. Let me go to the next ones because we like to get you out of here, at no more than 20 minutes for those of you watching. I'm going to go through these because these slides are a little bit in depth. Call me, message me. I can walk you through this whole presentation one-on-one. But if we look at this one here, now we talk about unemployment rates. Unemployment rates are super low. If we look here, 2022 are low. If we look at these dark lines here, let me go back, are showing us the recession periods, the small little times where it hit. But if you look at the the unemployment rates. That's another big thing when people are buying houses. If you're unemployed, you're probably not buying houses. Unemployment's high, less buyers in the market. Well, look at the unemployment rate here. What does that tell us? People are still working, making money. They might be paying more for their bread, their milk, their gas, and some of their other stuff that they're buying, but they're still making money and they're still able to go out and buy a home. So if you're a real estate agent, get people to move because prices will go up and rates could go up. So there's a lot of different issues here. So if you look at mortgage rates during recession times, I think this is very interesting as well. Interest rates seem to kind of go up in recession times. If you see, this is the 2008 to, 2010 rates were high, right? Rates, you see those little spikes and all of these things, rates were up. 18% right here, right? When we hit the little recession right here, the rates were starting to go up right here. And there's a better slide in a second I'm going to show you, but they dropped, with the pandemic. And now they just started to climb. But if you look at this chart and look at interest rates, guys, I want you to look at this because we're still at an all-time low. We're going back to 1972. If you kind of go scroll through here, 1972, 7.5. If I'm talking to a client right now and I shared this slide with them, I'm going to say, what if rates did go back up to 7% and you took a 5.5% interest rate? How are you doing? You're doing pretty good. And if we all I believe history repeats itself at some time. Well, this curve somewhere down here could end up over here somewhere. We don't know. And if I can land here, I think I'm doing pretty good, right? I think we can all agree with that.
Chris, can you address one thing? So I always say this backwards. So help me say it properly. In 2008, the housing bubble led to the recession, right? Or am I saying that backwards?
Nope, it caused it. The housing bubble actually caused the recession where we're in the recession. Housing had nothing to do with this recession.
Right. So in a true recession, there is really no play on the housing market. If there's any play, the housing market continues to go up. So we have to get out of this mentality that there's going to be a bubble and it's going to tank the economy, because there was very unique circumstances back then that just aren't existent today.
A lot of it was the studio mortgages really that played a huge part in that. And that they put these really good fail stops in place to protect consumers because of that event. And we're not seeing those prepayment penalties and all these different, we used to call them Section 32. It's been so long. Section 32, you used to have to sign literally a waiver saying, I know basically I'm taking a horrible deal. We used to have our clients sign it. Well, we got to let them know that this is a horrible deal and that they know they're doing it. And probably 70 to 80% of the loans where people were signing these Section 32 forms. It was crazy. Housing stays strong through recessions. If you look at this chart, right? There's no dip, guys. Whoops, let me go back. There's no dip in all these recession periods. You see it, they still actually continue to climb. Only time it dipped, guys, is when we seen what happened here.
Which is where the market, and look at that. If you zoom in, well, which you're not going to, but if you look closely, the market was up. The market tanked, causing that recession. What we had just said there.
Yep.
Which is different than normal.
Yep. And then lastly, let's talk about record low inventory. This is a big deal. Recession or no recession, right? We have in the peak back there, you had 13.7 million, you had all these houses on the market, right? Lower demand. Look at now, we're short 3 to 5 million on new construction. We're short. We have a shortage. We have more people, right? We have more people. I think, Mindy, you and I were talking. You said that there's more people born during this recession. I wonder why. People were home a lot, right? So
birth rates were at highest over the last 2 years. Highest rates in a while, I should say. I don't know when since, but highest in a while. And that means that more families. So the way,
growing.
What's that?
they're growing, so they
Yeah.
need to upsize in some cases.
Precisely. The way that economists measure that, they call it household formation. So all that's saying is that you have a new family unit, kind of that's going to be moving into a home or the market to buy a home. And household formation is at its highest right now that it's been in a long time. The long trend, birth rates are going down, yes, over the long period, but in more recently, there was absolutely a spike. And so that means that this demand that we see right here, it's going to get even greater as the baby carriage gets a little too big for their small homes.
It's amazing. So the last slide, which we'll close this out, is number of households. We kind of tied it in. If you look at the last one, right? Demand's high, right? Tons of stuff on the market. No inventory on the market, low inventory, shortage on new construction, shortage on supplies. But now look at how many people. We're, a quarter more people, that are with a shortage of real estate, which means what we have is going to keep selling. It actually is not even enough. We don't even have enough. So when we're talking to our clients and say, I'm going to wait for this bubble to burst, guys, please, trust me on this. Don't trust me. Trust historical information. And if history repeats itself, as we know it does over and over and over again, we're doing our clients a disfavor if we're not stressing the facts that, right? Let me go back so I can just show this. Stressing the facts. Call me. I can share this with you.
Yeah, the reason that we're harping on this right now is because literally just earlier this week, there were certain individuals in the media, we aren't going to say who, but we're harping and fear mongering. And I mean, all of it is it's just nonsense. They're saying it, they hear the word recession and then they start spewing off things that just aren't truthful. And then for good reason, like who has time to sit and look at these economic numbers? Like none of us do. And so your everyday person is going to think, oh, recession bad. That means I should probably wait and buy a home. Back in 1982, like I said last time, that consumer reluctancy was this low. Those who did buy a house, they saw major increases in appreciation of their house over the following 5 years. And that's exactly what we expect to see now.
And low demand, guys, low properties. We're going to close at this. Low demand, right? The rents are higher. So if you're not buying, you're going to be paying more for rent right out of the gate. And if you look at the rates again, check out the rates that you see in front of you. We're still at an all-time low. This slide would be a very awesome slide for you guys to share with your clients or your potential clients.
We should just plaster this all around everywhere.
Boom.
All right. Well, thank you so much, everyone, for taking the time today and joining us. We'll be back next week with whatever topic, whatever ridiculous thing the media says, we'll address it next week. So Chris, thank you so much for your time. If you ever have any, for our participants, if you ever have any topics that you're wondering about or that you're hearing about and you want clarification on, send those our way. Because we're always looking for topic ideas. It's fun to harp on and disagree with what the media is saying, but if you have something otherwise, please let us know.
Awesome.
With that, I hope everyone has a great Thursday and a good weekend.
Thank you guys for joining. Talk to you soon.